A market can appear calm for weeks, even months, while the forces that ultimately reshape prices are quietly building beneath the surface. And nowhere is that more evident than in silver today. Headlines often focus on daily price swings, a single warehouse report, or one economic release. But history shows that the biggest moves in precious metals rarely begin with dramatic headlines. They begin with subtle changes in physical demand, shifts in monetary policy, evolving investor psychology, and growing pressure between financial markets and the real economy. That is why silver deserves far more attention than it is receiving today. While many investors continue watching stock indexes, artificial intelligence companies, and interest rate expectations, one of the world's most strategically important metals is experiencing a transformation driven by industrial innovation, monetary uncertainty, and tightening supply dynamics that could define the next stage of the precious metals cycle. Silver occupies a unique position unlike any other major commodity. It is both an industrial material essential to modern technology and a monetary asset that has preserved wealth for thousands of years. During periods of economic expansion, manufacturers require increasing quantities of silver for electronics, renewable energy systems, electric vehicles, medical equipment, telecommunications, and advanced computing hardware. During periods of financial uncertainty, investors also seek silver as a store of value alongside gold. This dual identity means silver can benefit from both economic growth and rising financial risk, creating a combination that few other assets can replicate. One of the most important developments shaping today's silver market is the steady growth in industrial consumption. Global electrification continues to accelerate despite periodic economic slowdowns. Solar power installations remain a major source of silver demand because photovoltaic cells require highly conductive silver paste to maximize efficiency. Although manufacturers continually work to reduce the amount of silver used per panel, expanding production volumes have largely offset those efficiency gains. At the same time, electric vehicles require substantially more silver than conventional automobiles because of their complex electrical systems, battery management technologies, safety sensors, and power electronics. Beyond transportation, expanding data centers, cloud computing infrastructure, artificial intelligence hardware, and next-generation communication networks continue increasing demand for highly conductive metals, placing silver in an increasingly strategic position. Supply, however, responds far more slowly than demand. Unlike commodities whose production can increase rapidly following higher prices, most newly mined silver is produced as a byproduct of copper, lead, zinc, or gold mining. That means silver output depends largely on investment decisions driven by entirely different metals. Even if silver prices were to rise sharply, mining companies cannot simply double production within months. Developing new mines requires years of exploration, environmental approvals, financing, infrastructure construction, and operational planning. This structural characteristic limits the industry's ability to quickly respond to rising demand and has contributed to recurring supply deficits in recent years. Another important factor involves visible inventories held within major exchange warehouse systems. Investors frequently monitor these inventories because they provide insight into the availability of deliverable metal. Changes in warehouse stocks, however, should never be interpreted in isolation. Inventories may rise because of temporary logistical adjustments, seasonal shipping patterns, import timing, financing transactions, or strategic positioning by market participants. Likewise, inventories may decline because manufacturers are drawing metal into production, investors are increasing physical ownership, or market participants are reallocating holdings. A single weekly increase or decrease rarely defines the long-term trend. Instead, consistent movements over months often provide more meaningful signals regarding underlying market conditions. The relationship between futures markets and physical markets remains another area attracting increasing attention. Futures exchanges primarily facilitate price discovery and risk management. Most contracts are closed or rolled forward before physical delivery occurs. Nevertheless, the availability of deliverable inventories remains important because it supports confidence in the pricing mechanism. When market participants increasingly request physical delivery rather than simply extending financial positions, analysts naturally pay closer attention to warehouse flows and inventory classifications. That does not necessarily imply imminent market disruption, but it does encourage closer examination of supply conditions and delivery trends. Meanwhile, monetary policy continues influencing precious metals through multiple channels. The path of interest rates remains one of the strongest drivers of investor sentiment toward both gold and silver. Higher interest rates generally increase the opportunity cost of holding non-yielding assets, while lower rates often improve the relative appeal of precious metals. Yet the relationship is rarely straightforward. Investors also evaluate inflation expectations, economic growth, labor market conditions, fiscal deficits, and financial stability. Even during periods of elevated interest rates, concerns regarding government debt sustainability, slowing growth, or geopolitical uncertainty can continue supporting demand for defensive assets. Inflation itself remains a central consideration. Although headline inflation has moderated from previous peaks in many developed economies, underlying price pressures have proven more persistent than many policymakers initially expected. Housing costs, wage growth, energy markets, and service sector inflation continue influencing expectations about future monetary policy. If inflation proves more durable while economic growth slows, central banks face increasingly difficult decisions regarding the balance between controlling prices and supporting employment. Such environments have historically increased investor interest in hard assets capable of preserving purchasing power over long periods. The US dollar also plays an essential role. Because silver is internationally priced in dollars, currency movements significantly influence global demand. A stronger dollar can make precious metals more expensive for international buyers, while a weaker dollar often improves affordability and supports broader demand. Yet currency markets themselves respond to changing expectations surrounding interest rates, fiscal policy, economic growth, and international capital flows. Investors therefore monitor not only silver itself, but also treasury yields, inflation data, employment reports, manufacturing surveys, and central bank communications. Gold's performance provides another valuable reference point. Historically, gold often attracts institutional investment first during periods of rising uncertainty. Silver frequently follows later, sometimes outperforming once investor participation broadens. This relationship is commonly reflected through the gold-to-silver ratio. While no single ratio guarantees future performance, unusually elevated readings have historically indicated periods when silver appeared inexpensive relative to gold. Whether such historical relationships repeat depends on future economic conditions, investor behavior, industrial demand, and monetary developments, but many analysts continue monitoring this ratio closely for potential signals. Central bank activity further reinforces the broader precious metals narrative. Although central banks overwhelmingly purchase gold rather than silver, sustained official sector gold accumulation reflects growing interest in reserve diversification. Many monetary authorities have increased gold holdings as geopolitical tensions, sanctions risks, and questions surrounding long-term reserve management have become more prominent. While these purchases do not directly remove silver from the market, they strengthen broader confidence in tangible monetary assets and often improve investor sentiment across the precious metals sector. Geopolitics introduces another layer of complexity. Trade policies, regional conflicts, shipping disruptions, export controls, and supply chain realignments increasingly influence commodity markets. Modern manufacturing depends upon reliable access to strategic materials. If transportation costs rise, trade barriers increase, or supply chains become more fragmented, regional pricing differences may become more significant than in previous decades. Markets that once functioned as highly integrated global systems may gradually become more segmented, requiring investors to analyze regional dynamics alongside global fundamentals. Institutional investors also continue adapting portfolio strategies. Pension funds, hedge funds, commodity trading advisors, sovereign wealth funds, and family offices increasingly evaluate diversification beyond traditional stock and bond allocations. Rising government debt, changing inflation expectations, and heightened geopolitical uncertainty have encouraged broader discussions regarding portfolio resilience. While institutional allocations to precious metals remain relatively modest compared with equities or fixed income, even small percentage changes among large asset managers can generate meaningful demand within comparatively smaller commodity markets, such as silver. Retail investors approach silver from a different perspective. Many view physical bullion as financial insurance rather than a speculative investment. Coins and bars held outside the banking system provide psychological comfort during periods of economic uncertainty. Others participate through exchange-traded products, mining companies, or futures markets. Each approach involves distinct risks and opportunities. Physical ownership emphasizes wealth preservation and independence from financial intermediaries, while financial instruments offer liquidity but introduce different forms of market exposure. Looking ahead, several scenarios deserve consideration. In a bullish scenario, inflation remains persistent enough to limit aggressive monetary easing, while industrial demand continues expanding through renewable energy investment, electrification, and digital infrastructure growth. Mine supply struggles to keep pace with structural demand, supporting gradually higher prices as investors increasingly recognize tightening fundamentals. Continued geopolitical uncertainty and elevated fiscal deficits further strengthen demand for precious metals as portfolio diversifiers. A bearish scenario cannot be ignored. If global economic growth slows significantly, industrial demand could weaken temporarily, reducing near-term silver consumption. Simultaneously, a stronger U.S. dollar combined with persistently high real interest rates could discourage investment demand. Under such conditions, silver prices could experience meaningful volatility despite favorable long-term fundamentals. Commodity markets frequently overshoot in both directions, reminding investors that structural trends rarely eliminate cyclical corrections. A more neutral outcome may prove equally plausible. Inflation gradually moderates. Central banks cautiously reduce interest rates. Industrial demand continues growing at a sustainable pace, and mine supply expands modestly through existing projects rather than major new discoveries. Under this scenario, silver prices could remain volatile, but establish a higher long-term trading range, supported by improving structural fundamentals without experiencing dramatic shortages or speculative surges. For investors, perhaps the greatest lesson comes from history itself. Precious metals rarely move according to simple narratives. Markets respond simultaneously to monetary policy, industrial demand, fiscal developments, investor psychology, technological innovation, geopolitical events, and supply constraints. Focusing exclusively on one indicator risks missing the broader picture. Sustainable analysis requires connecting these factors rather than treating them independently. As the months ahead unfold, attention should remain focused on several key indicators. Inflation reports will shape expectations regarding future interest rate decisions. Treasury yields will influence the opportunity cost of holding precious metals. Manufacturing activity will provide clues regarding industrial silver consumption. Currency markets will affect international purchasing power. Mining production reports will reveal whether supply can respond to growing demand. Exchange inventory trends will offer additional context regarding physical market conditions, while developments in renewable energy, artificial intelligence infrastructure, and global trade policies will continue influencing long-term demand expectations. Ultimately, silver's story extends far beyond daily price charts. It reflects the intersection of technological transformation, monetary evolution, industrial modernization, and global economic uncertainty. Whether prices advance rapidly or consolidate for an extended period, the underlying forces shaping this market deserve careful attention because they reach into nearly every major trend defining the modern economy. Investors who focus only on short-term volatility may overlook these deeper structural developments, while those who study both macroeconomic conditions and physical market fundamentals are often better positioned to understand how the market is evolving over time. If you found this analysis valuable, share your perspective in the comments and subscribe for more in-depth coverage of precious metals, macroeconomics, and global financial markets. This presentation is intended solely for educational and informational purposes and should not be considered financial, investment, tax, or legal advice. Always conduct your own research and consult a qualified financial professional before making investment decisions.